By now, I'm sure you've seen the headlines in the news about the state of the housing market. Inventory is super low. Interest rates are the highest they've been in years. Are we on the verge of another collapse of the housing market? Relax. Everything's gonna be okay. Let's get into it. How you doing, everyone? I'm Derek from M1 Realty. I'm the broker owner here. We've built this company into the largest real estate firm in the city of Ferndale, Michigan. Been going strong since 2014, and I have got an all-star team of agents ready to help you no matter what your needs are, whether it's buying, selling, investing, renting, you name it, we got you covered. I'm excited to get into this video and explain how the housing market right now is way different from how it was 15 years ago. But before I do, please do me a huge favor, like this video, subscribe to this channel, and most importantly, share this video to anybody that you think would benefit from it. It really helps me out, and I really appreciate getting in front of people just like you who would get benefit from this topic. So first things first, this market is completely different from how the market was in 2007, 2008, because at this point in time, right now, late April, early May 2022, the market is doing what it's supposed to be doing in this situation. All of the forces that are impacting the market right now are easily explainable. It's completely supply and demand driven. But let's back up real quick. We'll talk 2007, 2008, the market that we're in 15 years ago. That housing market crashed 15 years ago because foreclosures flooded the market. And this happened for a couple of different reasons. One of the reasons that this happened was because banks, for whatever reason, drastically lowered their lending standards to just an absurd level. They started offering these really risky mortgage products, and they offered them to people who really couldn't afford to obtain mortgages in the first place. One of the most popular products at that point was an interest-only adjustable rate mortgage. Now, I'm not going to bore you with all the minute details of what that is, but essentially, it allowed people to purchase homes that were way above the price point that they would be qualified for in a normal situation, because it only expected them to pay the interest on the mortgage instead of the principal. So all that did was add the principal back into the to the top of the mortgage. So as they were making their payments, they were actually owing more and more because they weren't buying down the principal at all. They were just paying the interest on it. And what happened was, once those mortgages adjusted and their payment went drastically up, they couldn't afford to make those payments anymore. And once enough of those hit the market, then that started a cascading effect and just brought the whole market down. The other main reason why the mortgage crisis happened in 2007, 2008 was because for a while there, people were using their homes like ATMs. Like the value kept going up and up and up, and they started pulling all the equity out of their house, so that when prices started going down, all of a sudden they owed more on their house than what it was worth. So what ended up happening was that whole house of cards was built on the belief that home prices would just continue to go up forever, and of course that's not what happened. And then the end result was just like a explosion of foreclosures, which completely tanked the housing market. Now, how analysts and big banks didn't see this is beyond me. I'll never understand that. I personally got into the real estate business in 2003, and by 2005, I hadn't been in the business very long, but I could see that we were headed for a world of hurt. In fact, I can use my own experience as an example. So I purchased the home that I'm living in Ferndale in 2005, and basically, I'd been in the real estate business 2 years. I had decent income, but that didn't matter. They just did a stated income, no documentation mortgage for me. They just based it off my credit score. And, when I was, my loan officer that I was working with, he was at my office, working on my pre-approval. And at one point I stepped in while he was working on it, and I said, hey, what do you think I'm going to be qualified for here? And literally his response was, how much you want? And, luckily, obviously I was responsible, and I kept my, I knew exactly where I wanted my monthly payment to be, what I was comfortable with. So I didn't go crazy on it. But literally, I could have just told them I want $2 million, and they would have given it to me just off my credit score. They just, took my word for it that I could make the payments back, which is absurd when you're dealing with a 30-year mortgage. That's just crazy. But that's what was happening all across the country. And you guys all know the rest of the story. You could drive down any street in America. Every third house had a for sale sign in front of it. Prices were bottomed out. It was a complete mess. Luckily for me, at that point in time, I got into the foreclosure listing business, which kept me going in the real estate business for a few years till the market shifted back. But so I've seen the worst of the worst. I had a front row seat for it. I was right in the middle of digging our economy out of that. And that's why I'm pretty good authority. Like, I don't have a crystal ball, but to me right now, today's market is completely different from that. For one thing, as a result of that mess 15 years ago, lending guidelines are a lot stricter now. I mean, believe this or not, you actually have to have money to be able to buy a house now. Can you believe it? Oh yeah, the one thing I forgot to mention was when I got my mortgage back in 2005, I didn't have to put any money down. It was zero down. 100% financed. Like, you can't do that today. You have to have some skin in the game as a buyer. And not only that, but like I said, the mortgage guidelines are a whole lot stricter. They go through all your financials with a fine-tooth comb, make sure that you've got a good payment history, your credit's good, you have decent income, your debt-to-income ratio is where it needs to be, to ensure that you're actually going to be able to repay the loan that you're taking out. And those interest-only adjustable rate mortgages are a thing of the past. They don't offer those anymore. So the mortgage products that are offered by the banks today are much less risky than they were back then. Another reason why I don't see this current market as being on a bubble or about to crash or anything like that is because homeowners are also being a lot smarter with their equity now than they were back 15 years ago. Now, there's many factors for this, but part of it is that people learn their lesson and they're not going to use their house as an ATM anymore. Some of it has to do with COVID. Some of it, there's a lot of reasons for it, but fact of the matter is, right now across the United States of America, 42% of homeowners have at least 50% equity in their house right now. And just to break that down, in case you're not sure what that means, it means that basically 42% of the homes in America, they only owe half of what their house is worth at the moment. So the rest of that is just equity. It's just money that's sitting there that they could tap into through a home equity line of credit or a couple other, refinancing. There's a couple ways to do that, but they're choosing not to, which to me is a very smart choice. And again, across the United States, the average home right now has $307,000 in equity sitting in it, but people are doing the right thing and they're keeping that equity in their house right where it belongs. And I'm still hearing from people who are, wondering about, what effect our forbearance is going to have on the market moving forward. Are those gonna, turn into foreclosures and in turn, tank the housing market again? And I don't think that's going to be a factor, and I'm going to tell you why. Now, there's definitely still, people who are in the forbearance process, but those people have several options to get out from under that. And again, for people that aren't sure exactly what a forbearance is, I know it sounds a lot like foreclosure, but a forbearance is it's a process that got rolled out right when COVID hit, and like nobody knew what was gonna, be the long-term effect on the economy. So essentially, what mortgage companies allowed you to do was just hit the pause button on your mortgage, and you were exempt from having to make payments. At first, it was I think up to 6 months, and then at the end of it, it got extended out to 18 months. So you could literally have gone a year and a half without making a payment on your mortgage with zero penalty whatsoever. And I'll get into forbearance and the effect that had in a second, but worst case scenario, even if everybody that has a forbearance still right now didn't get out of it, it still wouldn't be enough. Those would turn into foreclosures, but it still wouldn't be enough to really make a dent into the housing market. In fact, one of the benefits of the forbearance process was that it did prevent a lot of foreclosures from happening. Say you were in, financial difficulty because of COVID, or maybe you're having issues with your finances before COVID even hit. That gave people an extra, 2 years essentially, where they could work out their finances, get with the mortgage company, figure out a way to restructure the mortgage, work out a repayment plan. There's all kinds of options available. These banks don't want to foreclose on you unless they absolutely have to. It's not something that, they're looking forward to because, they lose money every time they have to foreclose on a house. So, they'll do anything that they can to restructure a mortgage and avoid having to foreclose on somebody. So even with all those repayment, restructure options, inevitably a certain number of the people that took forbearances are going to end up getting foreclosed on. But if and when that happens, it will be a fraction of the foreclosures that we had 15 years ago. In fact, it really wouldn't make a dent in home values at all, because inventory is so low right now. We could actually absorb, there could be 1 million homes this year that got foreclosed on, and our market will absolutely absorb that. It wouldn't even be enough to make up for the demand that's currently out there. And then people also ask, hey, I know interest rates are going up, is that going to have any kind of effect on the market, bring prices down, cause issues? And as of right now, knock on wood, they're still going up a little bit at a time, but it's not a huge jump like we saw recently where, they went up, a full percentage in about 2 months, from 4% up to 5%. And this last month, it's gone from 5 to like 5.25. So it's definitely still the rates are still increasing, but they're slowing down at the rate that they're going up. So we'll see what happens. Again, I don't have a crystal ball, but as of right now, where we're at in the market, the rise in interest rates hasn't impacted demand one bit. And obviously, if the demand is still there and the supply is still low, prices are going to continue to rise. So, I think that if you're looking to purchase or sell a home this year, and probably even next year, I think it's probably a pretty safe time to do it. I don't think you're going to get, you're going to get caught, in a bad investment with, purchasing at the top of the market and then things are going to tank. I just don't see it happening, because there's really not a reason why. And of course, if anything does change substantially, you can expect to see a video from me right away, letting you know what's changed and how we're going to react to that. And of course, if you ever have any questions about the housing market or housing in general, you can always reach out to me anytime, day or night, call, text. My direct line is 586-491-5622, or you can email me, dwerenka@m1realty.net. And until next week, thank you so much for watching. I really enjoy making these videos for you. I hope you find them informative and at least mildly entertaining. So if you would, please, again, like this video, subscribe to the channel, and most importantly, share this out to anybody who you think will benefit from it. I really appreciate the opportunity of getting in front of other people just like yourself that I can bring some value to. Thanks again, and we'll see you next week, guys. Have a great day.